Good day. My name is Robert Stowe England, and I'm here today to shine a spotlight on the causes of the financial crisis of 2008. If you were like me when this crisis broke, you were shocked and outraged that things could get so out of hand and cause such an enormous calamity, the worst financial crisis of modern times. Something had gone terribly wrong to deliver us into the world of Mad Max, where the norms we thought necessary for society had vanished. We saw financial institutions crashing all around us, while authorities seemed powerless to do anything about it. As a financial journalist, I covered the mortgage industry at the heart of the crisis. I was on the front lines reporting a multitude of institutional and market failures that began to unfold early in 2007. By August 2007, fully half the mortgage market had collapsed or had to be rescued. By September 2008, most of the rest of the mortgage market had to be salvaged by the government takeover of Fannie Mae and Freddie Mac. As the bills for the crisis mount, the cost of bailing out Fannie and Freddie have been the biggest for taxpayers, nearly $175 billion so far. The final tally could rise to $380 billion, according to Washington estimates, or nearly $700 billion, according to the Standard & Poor's. At the time of the crisis, the mortgage market was probably the largest single financial market in the world at $11 trillion. From the beginning, as a journalist, I found mortgage banking to be a fascinating, tough, and dynamic industry. Mortgage bankers sometimes had to be as vigilant and focused as fighter pilots in order to navigate the challenges they faced. Those who took their eyes off the ball were dealt a swift and ruthless judgment by competitors and the markets. Mortgage companies survived by being nimble and quick. They were able to double their capacity to originate loans in short order when necessary, or cut their capacity in half. The value of the assets mortgage bankers owned could be decimated by falling interest rates. If you made bad loans, you had to buy them back from the investors and take the losses. The markets ruled with a vengeance. It was not just Adam Smith's famous invisible hand at work. It was more like an invisible fist. It was my first year on the mortgage beat that I met and profiled Angelo Mazzillo, co-founder of Countrywide Home Loans. To interview Angelo, I went to the company's headquarters in Pasadena, California. At 47, he was already known for his perpetual tan. Mazzillo was the epitome of the dynamic mortgage market, and Countrywide became the pace setter and leader of the industry. Mazzillo had a passion for mortgage banking that suited the business. By 2009, however, Angelo had become the chief villain of the financial crisis on the front page of the New York Times. Something had gone terribly wrong. In the early 1990s, virtually the entire mortgage market was made up of sound credits. By 2008, $4.7 trillion, or nearly half of all mortgages outstanding, were risky loans. This huge volume of bad mortgage credits is at the root of the financial crisis. The road to ruin for the mortgage market began in 1992, when Congress passed a law that established a regulatory framework for Fannie and Freddie. The short name for the law is the GSE Act. GSE is short for Government-Sponsored Enterprise, a firm privately held by shareholders but with a mission assigned by the government. The GSE Act was supposed to assure that Fannie and Freddie would be operated in a safe and sound manner and not meet the same fate as the savings and loan industry, much of which had failed in the 1980s. Washington policymakers thought that turning mortgage loans into securities would avoid the problems of the savings and loans that held mortgages on their own books. Fannie and Freddie would buy mortgages and pool them in a trust and issue mortgage-backed securities that Wall Street would sell to investors as AAA bonds. They were AAA because of the implicit guarantee of the federal government. Today, they're no longer AAA, by the way, because S&P downgraded the government to AA plus, I believe. So those mortgage-backed securities are now AA plus. In theory, securitization was a good idea, but the GSE Act created a set of rules riddled with flaws and Trojan horses that would bring about the downfall of the market. For starters, under the GSE Act, the regulator for Fannie and Freddie was not an independent agency like the banking regulators. Also, under the GSE Act, Fannie and Freddie had a tiny capital base of 2.5% that could be quickly wiped out by losses. Well-capitalized banks, by contrast, have to have 10% capital. Further, the regulator was not allowed to raise capital requirements for Fannie and Freddie if it deemed the capital levels to be inadequate, which it often did. Also, Fannie and Freddie did not have to file quarterly reports with the Securities and Exchange Commission, or SEC, like all other public corporations. They also did not have to audit their financial statements. All of these qualities I'm describing were written into the law by Congress in 1992. They were allowed to lobby Congress. They could hold securities on their balance sheets to boost profits and compensation for top executives, even though the whole point of their existence was to transfer that risk to investors. The law governing Fannie and Freddie was part of a new era in Washington, where it became official government policy to push down lending standards to expand home ownership to lower income and minority households. Over the years, as lending standards fell lower, the mortgage origination volumes rose higher, and there was a flood of money into mortgages, which helped launch the housing bubble. I warned way back in 1993 on the pages of Mortgage Banking magazine that trying to achieve equal outcomes for people with good credit and a good down payment and people with bad credit and little or no down payment was destined to cause grief and serious financial harm. The GSE Act also established affordable housing goals for Fannie and Freddie. Those goals are set not by the regulator, but by HUD. With Congress constantly applying the pressure, a succession of HUD secretaries, from Henry Cisneros to Andrew Cuomo to Alphonso Jackson, steadily raised the affordable housing goals. For members of Congress, this was a political bonanza. They could take credit for benefits for constituents without having to go through the budgeting process, no matter that the loans were made to people who could not pay them back. In 1992, 30% of all mortgages acquired by the GSEs were aimed at low-income and minority households. By 2008, the affordable housing goals had been raised to 56% of all loans must target that same population. To meet these goals, lending standards had to steadily fall. In 1996, Fannie and Freddie ventured into 3% down payments. In 2000, they launched no down payment lending. They also ventured into subprime lending, but mostly hid that activity by refusing to identify most of it as subprime. So many people were surprised in 2008 to learn that Fannie and Freddie were loaded up with subprime. In fact, they had $1.8 trillion in risky assets of one type of another, and yet no one really realized that, except maybe a few people who studied their reports. In 2003 and 2004, Freddie and Fannie were caught up in huge accounting scandals. Leland Brenzel at the helm of Freddie and Franklin Raines at Fannie were found to have manipulated earnings to increase their compensation. While both had to resign, Brenzel went quietly, but Raines went out kicking and screaming. Neither paid any real penalty for their fraud. Brinsell, who had made $30,000 in campaign contributions the prior year, walked off with $24 million, while Raines hauled off $92 million. The failure to hold Brinsell and Raines to account sent a dangerous signal, I think, to others who contemplated fraudulent schemes. Rewards could be huge and the potential downside limited. Fannie and Freddie grew so large that by 2004, Fed Chairman Alan Greenspan became worried that the failure of one would pose a risk to the entire financial system. Fannie and Freddie, however, are only part of the story of the financial crisis. Wall Street came up with private label mortgage-backed securities to compete with Fannie and Freddie, including jumbo mortgages, Alt-A or low or no documentation loans, and subprime loans. In 1995, HUD decreed that the GSEs could buy those private label securities to meet their ever-rising affordable housing goals. Former GSE regulator Jim Lockhart has said that Fannie and Freddie could never have met those goals without buying the private label securities. Fannie and Freddie and the private label originators fought for market share in a race to the bottom of the mortgage credit pool. With a pricing advantage, the GSEs took the stronger credits in the subprime market. New and increasingly predatory loans appeared. There were interest-only mortgages that did not pay down the principal and resulted in huge jumps in payments after only a few years. Just about anyone could qualify for a no-income, no-asset loan. And then they introduced the no-income, no-job, no-asset loan. It got to the point that mortgage brokers were scouting out illegal immigrants with menial jobs to give them loans even when the borrowers were not even thinking about buying a home. In South San Francisco, for example, a cleaning lady bought a house for $700,000 with no money down and walked away from the closing with $8,000 in cash. Shocked to learn how much each month's payment would be, she and her husband moved out of the house after 3 weeks and never made a single payment. That was happening all over the place in 2006. So what happened to the famed market discipline that ruled the mortgage industry? Beginning in 2002, Wall Street was having trouble selling the lower credit quality pieces or tranches of private label mortgage-backed securities to investors. These pieces were rated single A, triple B, and triple B minus. American institutional investors had stopped buying these lower-rated tranches that served as a buffer for the losses for the investors in AAA bonds. Without buyers for the lower-rated bonds, the subprime market should have corrected or even crashed. However, Wall Street came up with an idea. The idea of taking all of the lower credit pieces of subprime and other risky mortgage bonds and enrolling them into something else called a collateralized debt obligation, or CDO. Texas hedge fund manager Kyle Bass said it best when he called the subprime CDOs the biggest bait and switch of all time. Wall Street was able to sell those assets to European and Asian buyers who took the AAA rating as a seal of approval without seriously questioning the process by which the credit rating agencies gave them such a rating. These buyers of AAA CDO bonds had mountains of dollars from trade surpluses and recycled petrodollars that needed dollar investments. At a time of low interest rates, they couldn't resist the higher premiums offered by CDO bonds with AAA ratings. It seemed too good to be true, and it was. How could a bunch of bad credits roll together, create a good credit? It doesn't make sense. It was the financial equivalent of weaving flax into gold. Few seem to question this improbable fairy tale that was justified with sophisticated computer models. Even with willing buyers of the AAAs, the subprime CDO business faced another problem. No one really wanted the lower credit-rated CDO tranches, the single A and the triple Bs. But Wall Street firms came up with a solution to that problem too. They would sell each other those lower-rated tranches in order to generate the deals and earn the fees. Their gentleman's agreement was, you buy my triple B tranches and I'll buy yours. Often senior management at these firms did not understand the risk that this posed and sometimes did not want to know. All that mattered was that deals were generating huge bonuses for everybody. The creation of so many unloved, lower-rated tranches of CDOs caught the eye of hedge funds, who loved them because they were so bad. Hedge funds wanted them at first because of their high returns, but later they decided to bet against them. In time, hedge funds came to sponsor almost half of all CDOs. They would buy the equity piece of the deal for its super high premium, while at the same time making much larger bets against the lower rated tranches. They expected to get rich off the failure of the US housing market. Hedge funds were not supposed to choose the assets placed in the CDOs, but evidence suggests strongly that they were able to influence those decisions to include more of the worst credits. The demand from CDOs for weaker subprime credits, usually only a fraction of each deal, had a perverse effect. It greatly increased demand for mortgage lenders to increase the volume of subprime and risky mortgages to supply the bonds needed for the CDOs. In short, the subprime CDO business was poisoning the private label mortgage-backed securities business. In an outcome James Bond villain Goldfinger would love, Wall Street was creating a flow of funds into the mortgage industry in search of bad credits. Subprime mortgage originator Bill Dallas of Own It opened a window into this world when he said Wall Street was paying him more to do a loan with poor underwriting than one with good underwriting. Merrill Lynch and Citigroup were the kings of CDOs and bear much of the blame for the crisis. Merrill's chairman, Stanley O'Neill, made $91 million in 2006 while turbocharging the CDO business. A year later, Merrill had to take an $8.3 billion write-down on its earnings, and O'Neill was fired, walking away with another $151 million. At Citigroup, it was Robert Rubin who talked Chairman Chuck Prince into diving headlong into the CDO business. Citigroup hid the toxic assets it was creating in structured investment vehicles, or SIVs, off its balance sheet and in black boxes on its balance sheet. In the first and second quarter of 2007, Citigroup concealed the existence of $50 billion of subprime assets in its audited SEC filings, which of course is fraud. Even though top officials are required to personally sign accounting statements and be held personally liable, the SEC did not investigate Prince or Rubin. The case was settled with minor fines to lower-level officials. A whistleblower inside Citi named Richard Bowen tried to warn Rubin about the growing volume of bad mortgages feeding the CDO monster. Clearly, nothing was done. Citi would have failed if Treasury, the FDIC, and the Fed had not put together $476 billion in TARP funds and guarantees against losses from bad mortgage assets. Washington regulators' worst dereliction of duty was its failure to enforce the laws on the books that could have helped prevent or mitigate the crisis. The SEC was the weakest link, mostly by congressional design, but also because it was a lax enforcer of laws against fraud and market manipulation. Take the case of the naked short sellers that brought down Bear Stearns. On March 11th, 2008, an unidentified party made a $1.7 million bet through put options that Bear Stearns would collapse within 10 days. At the same time, rumors were widely circulated that Bear Stearns was out of cash even though they had $18 billion on hand. Investment funds began to pull out the brokerage accounts from Bear Stearns. In only a few days, Bear Stearns was down to $2 billion in cash and on the verge of collapse. More than 10 million shares of Bear Stearns stock were sold into the market by sellers, quote unquote, who did not own the shares or had not borrowed them as required by law. This pushed Bear's share price from $62 to $30. Facing a sudden demise, Bear agreed to be sold to J.P. Morgan for $2 a share, or $236 million, less than the value of its corporate headquarters. Meanwhile, the party who placed the $1.7 million bet made $271 million. There was an SEC investigation of the naked short selling of Bear shares, but no one was brought to justice. While the collapse of Bear Stearns should have been a wake-up call to Chris Cox at the SEC and Hank Paulson at Treasury, no one took steps to prevent naked short selling from bringing down other investment banks as the market now expected. Only 6 months later, in September of 2008, naked short sellers struck again. They sold tens of millions of Lehman Brothers shares this time, shares they did not own or borrow. In a matter of days, they forced the company into bankruptcy, precipitating the financial crisis of 2008. The SEC won't even say if there was an investigation of Lehman naked short sales. No one has been brought to justice. There is another painful lesson from the crisis. The architecture of the financial system had grown far more rickety and vulnerable. During 2007 and 2008, there were massive, mostly hidden runs on both the shadow banking system and on regulated banks and investment banks. It all began in August 2007 when a panic began in overnight funding contracts known as repurchase agreements, or repos. Firms can obtain cash by selling their assets overnight and buying them back the next day for a tiny increase in price on those assets. The panic got underway on trading desks when the parties that provided overnight cash wanted additional collateral above and beyond the value of the cash. They were asking for a haircut on the value of the assets. By the end of 2008, a year later, a steadily rising level of haircuts drained more than $1 trillion out of the banking system. It all happened out of the public eye, and virtually no one was aware that this amount of money was being taken out of the system, including the regulators. There were other calamities. For example, a run on SIVs that were funded by asset-backed commercial paper drained another $451 billion out of the system in late 2007. Credit default swaps, a form of insurance against debts, brought more financial pain. Margin calls on the swaps began to drain funds from the system, bringing down the world's largest insurance company, AIG. How did the financial system get so weak? That is the question I sought to answer. It was a monumental mystery that needed to be investigated and explained. Not surprisingly, people central to the story did not want to talk. I learned that the fastest way to a dial tone was to call a Wall Street firm and ask them to talk about subprime CDOs. Progress was slow, but I managed to piece together the story. I worked on this not just for my own understanding, but more importantly, to tell the American public what I had learned. Black Box Casino is a story about one half of the world of banking that is shadow banking. It is the story of how huge swaths of that shadow banking and financial activity moved into black boxes. And black boxes are financial institutions and vehicles with no transparency. You can't see inside and know what bad assets might be hidden there. I discovered through my work that some of these black boxes housed financial casinos where fast money and high stakes were the norm. Black boxes can also conceal fraud. We would learn only after its failure, for example, that Lehman Brothers filed public disclosures that hid massive manipulation of accounting. Mortgage bonds became attractive to market players who wanted to bet for or against them using credit default swaps. Leading up to the crisis, more than $20 trillion in bets were made on mortgage credit assets and other assets that were not owned by the people who were making the bets. In the end, I learned the painful reality of the new financial world order, or should I say disorder. The financial system had become more sophisticated and opaque and vastly more vulnerable. If we are to address the weaknesses in the system, we first need to understand what went wrong. For the most part, Washington has failed to do that. In some cases, Washington Pauls and officials have covered their eyes and ears to avoid seeing and hearing the truth. I hope my book will be a contribution toward understanding what went wrong, and I look forward to the efforts of others in this vital quest. The American people, indeed the people of the world, deserve honest answers.